While Meta and Twitter fight over social media, all the other big tech companies are laser focused on artificial intelligence. The tech-heavy NASDAQ has surged almost 32% as investors have piled in, afraid to miss out on the possibilities in the new tech. But how long can this rally sustain itself? Well, joining us now, we've got Michele Schneider, who is the MarketGauge.com chief strategist. Great to have you here with us this morning, Michele. Perhaps we start off with that very question. How long can this sustain itself?
Well, what's so interesting is that we started out this year looking at a very key moving average, which was a 23-month moving average. And really why we looked at that is that it measured a 2-year business cycle within the typical longer business cycle, right, between 6 to 8 years. And pretty much everything in NASDAQ and certainly the big AI stocks have cleared that, showing some level of expansion, starting actually with the semiconductor sector. But what has not been able to clear has been the small caps. And so we came in thinking if IWM, if we're going to use small caps measure through there, or you can look at S&P 600 as well, cannot show any level of expansion while everything else continues to rock and roll at some point. And we've seen this historically. The large tech looks around and says, wait a minute, nothing is catching up. And that's when you start to see selling coming in. And that's when you start to see some level of equanimity between what's happened in the large caps and what's happened in the small caps, which right now is just so divergent. It's like a rubber band. It doesn't feel sustainable.
So, Michele, is the AI trade saturated now or not yet?
I would say at this point, well, we'll take our own portfolio as an example. We have been in, not because we were such great geniuses from a thought standpoint, but from a pure math standpoint, if you just follow the technicals, we've been in the AI space all year and very heavy in tech. So we've taken profits along the way. So the question is, would you get in here? And I think in current environment, considering what we're seeing over the last couple of days, small caps couldn't get through and now they're starting to weaken. The consumer area looked like it was going to try to get bigger in terms of the discretionary space. That's contracting. The Fed obviously looking like they're going to raise interest rates again. I would say probably not the best time to get in.
Okay, and so with that considered, where else would you be placing your attention right now?
Well, I think this correction that we've had in particularly the agricultural commodities and even some of the soft commodities like sugar are now giving an opportunity to get involved with that space because the weather has not necessarily gotten any more cooperative in terms of drought and El Nino and then floods, and which often happens after long periods of drought. So we're looking there. We're looking at some of the basic materials. There has been a lot of talk, obviously, about increasing the solar space. Another announcement today by Biden that M-Phase was something that was going to get a $60 million infusion of cash. So I think anything that has to do with the EV space, not necessarily the EV space itself, but anything that supports the EV space. So we've been looking at some of the basic industrial metals again that got really beat up. Defense, I think, is always a good idea. And biotech, which has been really doing nothing for the entire year, could actually start to do a little bit better. We're looking there as well. Some of the ones, again, that have been beaten up in the IBB or the XBI space.
All right, Michele, so, okay, we're broadening out this conversation. So the adage used to be sell in May and go away. That didn't happen. You say sell in July. Should it be sell in July and fly?
Good one, Diane. I'm going to use that.
Go right ahead.
Well, July is a very interesting month because the year is half over, right? So what we had in January, and then we do it again in July, is a 6-month calendar range. And of course, nothing is 100% when you're looking at this sort of statistics. But in January, it worked amazing, right? As soon as we hit January, NASDAQ in particular reached above a 6-month calendar range high, which means that the first 10 trading days in January develops a range. And if you get above that range, you have a good edge in terms of it having follow through. And that happened. Whereas in the small caps, it happened briefly and it hasn't been above that 6-month calendar range high since. We reset now in 10 trading days, which will be about July 18th, once again. If these small caps continue to fall under pressure and break down under the July lows once we get to that point, and NASDAQ cannot clear that 6-month high again like it did in January, I would say that there's a good chance that, yeah, sell in July as we get into some really strong headwinds after all the optimism we had the first 6 months.
And we know that there's typically lower volume during the summer months as well. But even in that lower volume, are you anticipating that we'll see some slippage over the course of the rest of this summer, or just kind of some choppiness that is perhaps netting out neutral by the end of it, which for a lot of the banks that are still bearish for their outlooks for the S&P 500 by the end of the year, it seems like more of them are expecting that slippage to perhaps take place. And if that does take place and ensue during Q3, what does that even spell out for Q4?
Well, yeah, I mean, I don't think I remember seeing such different calls for what's going to happen in the market over the next 6 months. Some people think that we're going to new highs. And they're using all types of reasons why. You know, obviously, housing market is stronger and the jobs market is stronger. And from a technical standpoint, really, basically, what happens Thursday and Friday, we have not had 2 down days in a row since May on a Thursday and Friday. So people are looking at all these reasons to be extremely rosy. And then, of course, you have the banks that are looking mainly at this yield curve inversion, which has led to a recession almost every time, even if it doesn't happen exactly in the timing that everybody thought. So, yeah, I would say that we're definitely looking at, if we're looking at it as a trading range, and particularly going back, maybe even use S&P, forget about small caps. If 4,400 to 4,500 turned out to be the top of the trading range, which is completely in line with the small caps going to 1,900 and not getting through, then it makes sense that we could see a move down even closer to 1,700 in the small caps again, which of course would bring the S&P back down at least to 4,000 and maybe back down to 3,800.
Michele, you say a lot of people are looking for everything to remain rosy. Are you expecting something different for this back half of the year?
Well, again, the first 6 months, there was nothing but reasons to be cheerful. So, right, we had, first of all, the Fed certainly slowed down the rate of change in terms of how much they were going to raise the interest rates. And people were anticipating some kind of pause or pivot. And they themselves have said that they were going to kind of cap it at 5 to 5.25% in terms of the Fed funds rate. So that gave the market optimism. The economic situation was that it seemed like it contracted enough. The consumer was strong and continued to buy, whether it's because of YOLO or whether they thought that inflation had peaked. And that was the other thing, is people thought inflation had peaked. And all these reasons, and especially the AI explosion, gave the market optimism for 6 months, markets forward thinking. So now you have to wonder, where's going to be the optimism for the next 6 months? I'm not necessarily seeing it because there are so many areas that could be cause for concern, including geopolitical situation, social unrest situation, obviously rising yields, and inflation based on Mother Nature, that's not so easy to control. So the consumer is stretched, and we'll see if they can continue to stay in the game. If they can, that's a good reason to be cheerful. If they can't, not so much.